Financial ratio analysis. The usual method used to conduct an analysis of financial statements is to do ratio analysis. Ratio analysis is a method of analysis using comparative calculations from quantitative data contained in the balance sheet and income statement. Generally, the calculation of financial data ratios is done to assess the performance of a company in the past, present, and forecast or various possibilities that occur in the future. The use of financial ratios basically varies. This depends on the interests of each company. Financial ratio analysis, or known as financial ratio, is as an analytical tool to compare the numbers contained in financial statements and also to see or know the financial position of a company and assess the company's management performance in a certain period. Financial ratios can be divided into 5 parts. 1. Liquidity ratio. Liquidity ratio is a ratio that shows the ability of companies to meet short-term obligations, debt. A company that is able to pay its obligations or short-term debt is called a liquid company, while a company that is unable to pay its short-term debt is called an illiquid company. Most companies use liquidity ratios to measure their liquidity using current ratio. This ratio compares current assets to current debt. This ratio provides information about the ability of current assets to cover current debts. Included in current assets such as cash, accounts receivable, securities, inventories, and other assets. While those included in current debts include trade debts, notes payable, bank loans, salary debts, and other debts which demand to be paid immediately. How to calculate the current ratio with current assets/current debt x 100%. If the greater the ratio of current assets to current debt, the higher the company's ability to cover its short-term liabilities. It is analogous if the current ratio is 1 or 100%, it means that current assets can cover all current debts. So a company is considered healthy if the ratio is above 1 or above 100%. For the record, current assets must be far above the amount of current debt. Quick ratio. Quick ratio, or often also called asset ratio, is a balance between the amount of current assets reduced by inventories and the amount of current debt. Here, inventories are not included in the quick ratio calculation, because inventory is one of the smallest liquidity components of the current assets. In this case, the quick ratio is more focused on components of liquid assets that are more liquid, such as cash, securities, receivables that are associated with current debt or short-term debt. The formula to calculate the quick ratio is current assets, inventory x 100%. If there is a very significant difference between the quick ratio and the current ratio, where the position of the current ratio increases while the quick ratio decreases, this indicates that there is a large investment in inventory. This ratio will show the ability of liquid assets that are most liquid can cover current debt. Where the greater the quick ratio, the better, while for this ratio number does not have to reach 100% or 1, meaning that even if the ratio does not reach 100% and only close to 100%, then the company has also been said to be healthy. Cash ratio. This ratio is useful for comparing cash and current assets which can immediately become cash with good debt. In this case, the cash in question is the company's money that is stored in the office and that is in the bank in the form of a checking account. While assets equivalent to cash or near cash are current assets that are easily and quickly able to be cashed back. This can be influenced by the economic conditions of the state that become the domicile of the company concerned. The formula to calculate cash ratio is cash plus cash equivalent/current debt x 100%. This ratio will show the portion of the amount of cash added to the cash equivalent and then compared to the total of current assets. Where the greater the ratio, the better the ratio. This ratio is the same as the quick ratio, where the number does not have to reach 100%. 2. Solvency ratio. Solvency ratio is the ratio that has the ability to meet short-term and long-term obligations if the company is liquidated. Companies that have enough assets to pay all of their debt are called solvable companies, while those that are not called insolvable companies. Related to the calculation of the solvency ratio that can be used are 1. The ratio of total debt to total assets. Total debt to total assets ratio, debit ratio, or usually called debt and debt ratio, is used to measure the percentage of the amount derived from debt. where the debt in question is all the debts owned by the company, both short-term and long-term. The following is the formula used to measure the amount of a company's past debt. The formula for calculating debt ratio is total debt, total assets x 100%. This ratio will describe the extent to which debt can be covered by assets. Where conditions are getting smaller, the ratio of eating the safer, solvable. For the record, portion of the debt to assets must be smaller or below it. 2. Debt to equity ratio or debt to equity ratio. The purpose of the ratio of debt to equity is the balance between the debt held by the company and its own capital, or the higher this ratio indicates that the equity capital is smaller than the debt. If you have a company, we recommend that the amount of debt does not exceed your own capital. This is so that the fixed load is not too high, so we can conclude that the smaller this ratio, the better. The point is that the smaller the debt to capital, the safer it is. The formula for calculating debt to equity ratio is total debt, capital x 100%. I think that's all for today. Let's meet again next time.